Tonight, the financial world is buzzing as Netflix makes a bold move that has investors talking worldwide. A massive 10-for-1 stock split has officially taken effect, instantly reshaping the appearance of the company's share price and sparking new debate in the middle of an intensifying streaming war. But behind the headlines, the question remains, what does this really mean for the future of the world's largest video platform? Early Monday trading painted a cautious picture, with shares slipping slightly to just over $110, reflecting not weakness, but the mathematical adjustment of a split that multiplies the number of shares while keeping total value unchanged. And while stock splits no longer carry the psychological punch they once did, Netflix's decision comes at a pivotal moment as the company navigates slowing momentum, tax disputes abroad, and fierce competition from rivals hungry for a larger share of the global streaming audience. Every shareholder of record as of November 10th now holds 10 times the number of shares they did last week, yet their total equity remains identical. A reminder that stock splits are largely cosmetic, but cosmetic doesn't mean meaningless. In today's market, where tech giants like Apple, Nvidia, and Tesla have embraced splits to broaden retail access and boost trading liquidity, Netflix's move may be part of a broader strategy to refresh investor sentiment after months of pressure. The company's stock had already fallen 11% before the split even kicked in, weighed down by a rare earnings miss tied to a tax dispute in Brazil. For some investors, the decline is a warning sign, but for others, it looks like the perfect reset point, especially with analysts projecting strong growth in Netflix's cash generation and profitability over the next 2 years. And as the streaming battlefield grows more crowded, positioning matters now more than ever. Despite recent setbacks, analysts remain optimistic about Netflix's long-term trajectory. Forecasts show earnings before interest, taxes, depreciation, and amortization climbing to more than $16 billion by 2026, a powerful jump from the expected $13.3 billion this year. That type of expansion, if delivered, could ease concerns about Netflix's valuation, which still trades at a hefty multiple of future earnings. But investors aren't just watching numbers. They're watching strategy. Netflix's flywheel model continues to prove resilient. More subscribers mean more money for premium content, which attracts even more subscribers, reinforcing the cycle. It's a system that competitors have tried and failed to replicate at the same scale. Yet even with this advantage, analysts warn that Netflix may need to step outside its comfort zone, possibly through partnerships or acquisitions, to maintain its dominance as rivals strengthen their own content libraries and global reach. And now, the streaming war is entering a new phase, one that could reshape the entire industry. According to recent reports, Netflix, Paramount, Skydance, and Comcast are all preparing aggressive bids for Warner Bros. Discovery, with a crucial deadline approaching on November 20th. A successful acquisition could instantly transform the balance of power, giving the winning company access to a massive vault of franchises, global brands, and streaming assets. For Netflix, acquiring Warner Bros. Discovery would mark its first major leap into studio ownership, securing intellectual property that could fuel growth for decades. But the move wouldn't be simple. Regulatory hurdles, high costs, and competitive counterbids create enormous uncertainty. Still, the mere fact that Netflix is even in the race underscores a new ambitious chapter for the company, one that extends far beyond stock splits and quarterly earnings. It signals a future where consolidation for global streaming supremacy. As the bidding deadline approaches, industry analysts are closely examining what each potential buyer stands to gain from acquiring Warner Bros. Discovery. For Netflix, it would mean absorbing a legacy studio with a century of storytelling history, plus access to powerhouse brands like DC, Harry Potter, and HBO's award-winning library. Such an acquisition could dramatically accelerate Netflix's global influence, offering an unmatched catalog of blockbusters, prestige dramas, and iconic characters. But critics argue that swallowing such a massive studio could overload Netflix with debt and distract from its core streaming strategy. Still, in a market where content is currency, Netflix appears increasingly willing to take calculated risks. The company's leadership has publicly emphasized adaptability, something essential in an industry now defined by rapid mergers, aggressive licensing deals, and the constant race to secure exclusive content before rivals do. Meanwhile, Netflix continues refining its revenue strategy. Its crackdown on password sharing, once criticized, is now proving effective, driving a surge in new paid memberships. At the same time, the company's ad-supported tier is gaining traction, bringing in a fresh wave of budget-minded viewers while opening new pathways for advertisers. The combination of expanding viewer segments and disciplined spending has helped Netflix strengthen its financial foundation despite rising production costs. Analysts believe these moves provide the stability Netflix needs if it chooses to enter a high-stakes acquisition battle. But the company is also aware that missteps, overspending, regulatory pushback, or cultural clashes could threaten its carefully built advantage. For now, investors remain cautiously optimistic, watching how the stock responds post-split and whether renewed confidence translates into long-term momentum. Competition, however, grows fiercer by the month. Paramount Skydance sees a Warner Bros. Discovery acquisition as a chance to expand its reach beyond fading cable channels and limited streaming presence. Comcast, with its deep pockets and global distribution network, could integrate WBD content into Peacock and Sky, instantly strengthening its international appeal. In this landscape, Netflix's position is unique. Unlike traditional media companies balancing broadcast networks and theatrical divisions, Netflix is singularly focused on streaming, giving it agility, but also exposing it to vulnerabilities when growth slows. If it fails to secure major new content pipelines, rivals could eventually erode the dominance it has enjoyed for more than a decade. This makes the outcome of the upcoming WBD bidding war more than a financial story. It's a defining moment for the future direction of the entire streaming industry. At the same time, Netflix's global expansion strategy continues full speed ahead. The company has invested heavily in international originals, from Korean dramas and Spanish thrillers to European fantasy epics that have repeatedly gone viral worldwide. This global-first approach remains one of Netflix's strongest advantages, offering diverse content that many competitors struggle to match. Yet, the company must now balance its international ambitions with the realities of an increasingly fragmented streaming market. Subscription fatigue is rising, and consumers are becoming more selective about the platforms they keep. Netflix's challenge is not simply to attract subscribers, but to retain them, maintain cultural relevance, and consistently deliver hits in a world where trends shift faster than ever. Whether through acquisitions or bold creative strategy, Netflix must stay ahead of consumer expectations to preserve its global leadership. As Netflix enters this critical phase, the stock split becomes more than a technical adjustment. It becomes a symbolic reset. With a lower share price, broader retail engagement, and renewed attention from investors, Netflix is attempting to position itself as both accessible and ambitious. But the real story lies in what comes next. The outcome of the Warner Bros. Discovery bidding war, the company's ability to deliver sustained earnings growth, and its strategy for navigating tightening competition will determine whether Netflix remains the undisputed leader of streaming or begins yielding ground to hungry rivals. For now, all eyes are on the company as it steps into a defining chapter, one that could reshape not only its future, but the trajectory of the entire entertainment landscape. Whether this split marks a new beginning or simply a momentary shift will become clear in the months ahead.